So let's move towards the first important news, that is amid high inflation, RBI retains repo rate at 6.5%. Lot of expectation, but sadly it did not happen, or unfortunately, but on the positive side, inflation needs to be controlled. So MPC was set up by Memorandum of Understanding. What is MPC? Monetary Policy Committee, the topmost body which decides these rate, the benchmark rates like repo rate. So Memorandum of Understanding was done between the government and RBI about the conduct of new inflation targeting monetary policy framework, and the target for the RBI is to keep the inflation under 4%. RBI Act, that is 1934, it has been amended by Finance Act 2016 to provide a statutory and institutionalized framework for MPC. It also means that whatever MPC recommendation comes, that is mandatory, it is binding on the RBI. RBI will have to follow it. And in MPC, there are three people from the government in the overall committee, and 3 people would be from the RBI. Okay. So MPC is entrusted with the task of fixing benchmark policy rates like repo rate, required to contain inflation with the specified target, that is around under the 4%. So whatever be the target, that would be the focus. And what is repo rate? We have already covered. So repo rate is the amount or the rate of interest which is paid by the commercial banks. We have done this. Let's move forward. Okay, next is what is the composition of MPC? It has 6 members, 3 would be from the government side, represent the government, then RBI governor would be the chairperson, RBI deputy governor would be there, and 1 official nominated by RBI board. So 3 people from RBI side and 3 people from the government side, balancing it out. External members hold the office for a period of 4 years, and decision of MPC would be binding on the RBI, and that is why it has a statutory, a system has also been given to it. Now let's come to the news. Reserve Bank of India decided to maintain the repo rate at 6.5 for the 11th consecutive bi-monthly review. Lot of expectation from the ministers in the central government and the experts and industry experts and people and the company heads, honchos, CEOs was that the repo rate would be reduced. That will influx more amount of money in the market. It's very simple maths if you see. So when commercial banks borrow money from RBI, they have to pay interest. If that interest, right now it is 6.5%, for example, if it would have gone to 6 or 5.5%, they would have had to pay less amount of interest. So there would have been more influx of money. So repo rate and these benchmark rates are used to control the inflation. So when the repo rate increasing, it is basically to draw back or withdraw the excess amount of money which is in the market, which might be leading to inflation. Currently, we are having a problem of food inflation in country, which is growing very high. So in this context, though there was a demand of the market that the repo rate should be reduced, more amount of money should be, or capital should be infused in the market, because overall urban spending has reduced and the demand in the market is less. But since the food inflation is very high, since the food inflation is very high, RBI Reserve Bank of India has to balance the inflation also, and on the other hand, it also has to balance that the demand is decreasing. So in this context, they did not reduce the repo rate. It is at standard 6.5%, but they did reduce the cash reserve ratio from 4.5% to 4%, which would influx a lot of amount of money in the market. Good morning, Satish. Okay, so decision was made by this with 4 out of 6 members voting in favor. So that's it, 4 were, and that means other 2 might be wanted that the repo rate should be reduced, maybe. So the move reflects the central bank's efforts to balance inflation control and support economic growth. So again, that economic growth which the industry is demanding or the government is demanding, at the same time the inflation. So in this changing flux or in this balancing out, they have stuck or they have remained at that. We would be continuing with 6.5% repo rate. I think when if inflation comes down in 3 or 4%, I'm very sure the the Reserve Bank of India would definitely be reducing the repo rate. But again, they need to see how the inflation goes on. So this is it. Neutral stance. Cash reserve ratio has been reduced by 50 basis points from 4.5% to 4%, and this is also happening after 4 years. And what is the cash reserve ratio? So this is the the banks need to maintain a certain percentage of their total deposit as liquid reserves with the RBI. For example, if they have, say, a bank has 100 crore rupees, so out of 100 crore rupees, if this is 4%, if for example it was at 4.5%, so out of 100 crores, they would have to keep 4.5 crore with the RBI. Now since it has gone to 4%, now they will only have to put 4 crore with the RBI, remaining 50 lakh which is coming out, 50 lakh can be infused back in the market in terms of loans and etc. So in a very simple maths I'm trying to explain to you. So since the cash reserve ratio, the amount which these commercial banks needed to keep with the RBI, that has been reduced from 4.5% to 4%, and because of this there would be injection of 1.16 lakh crore into the banking system to ease liquidity stress. What is liquidity stress? The amount of money is not available. So if the amount of money comes, the loans also become very cheaper. So in that context, if the loans are becoming cheaper, in that sense people will borrow more loans and they will buy more houses, and overall spending would increase, spending and demand, then it will go in tandem. So that is what they are trying to do with the CRR. But if the repo rate would have also reduced, that would have also added in more infusion of money. Unfortunately, that did not happen. Unfortunately, the focus is to control the inflation. So this is what RBI is trying to control, the balancing out. Okay, so I hope that you've understood all this thing. Sir, I want last 6 months current affair. Okay, we started current affairs somewhere around 17th of October. From that time till date you can get. So prior to that we were not doing daily decodes. Now we have started, so till that time you can easily get. Now rest of what is meant by key monetary, that what is cash reserve ratio I've already told, and apart from that there is also one more thing done so that more investment come from abroad, that is interest rate ceiling on FCNR deposits. So FCNR deposits are which has been, these deposits are done by NRIs from outside. So the interest rate on this has been increased so that they deposit more. So these are term deposit that can be opened by NRIs, foreign currency, with banks in India. So increase in interest rate ceilings on aim to attract. For example, if an NRI was depositing 10 rupees, on 10 rupees he was getting 3%. So that means 13 rupees he would be getting. Now instead of that 3%, if it has been increased to 4%, now he would be getting 14 rupees. So that is what, that is how they have been working on this. So on 10%, if they increase 4%, 3%, 2% in a very simple way. Sorry, not 3-4%. I mean to say on 10 rupees, if it is 30%, again a very high number, you will never get this kind of fixed deposit. So for example, on 10 rupees, if you get 30%, you get 3 rupees, it becomes 13, and if it has been increased to 40, it would be 40%. I went to maths. Maths was a problem in CSAT also. Anyways, so this is basically the interest rate would be increasing, and you will be thinking that on my 10 rupees, 100 rupees, if it was earlier, 3% and it has gone to 4%, I will get more money. So let me deposit more money into the banks with India. So that's the more focus, so that more people put money in this and they get, more returns. What is FCNR, foreign currency non-resident accounts? Purnima has already answered. Foreign currency non-resident accounts. So non-resident accounts who are outside India, they can use Indian banks and deposit money, and they will be getting more interest now. So this is how they are trying to increase. Now inflation, retail inflation for 2024-2025 has been revised to 4.8. Please remember the target is to get less than 4%. Food inflation pressures expected to ease in coming time. That's a good news. Growth projection, not a good news. Already the numbers had come in the last quarter. When we were discussing, the quarter was around 5.6, 5.4%. Expectation was somewhere around 6.5 to 7%. Now RBI has also revised its GDP growth rate for 2024 to 2025 to 6.6%. Please get this, earlier this was 7.2%. Now it has come back to 6.6%. So economically we are moving towards more sluggish economy, which looks like right now. Hopefully it might get revived. It is very important, these two wars which are going on, that is Russia, Ukraine, Israel, Hamas, and the third one which is starting in Syria, this needs to be resolved ASAP. Okay. Now again, moving further, challenges ahead, adverse weather events, geopolitical uncertainties, financial markets volatility. This is what RBI is talking about. Geopolitical war is going on. I mean to say, a lot of wars are going on. That is Russia, Ukraine, and then the second is Israel, Hamas, Houthi. Syria is also starting, and I hope when Trump takes the seat on January 20th, he'll be able to resolve it. Second, he's talking about tariff wars, that he would be putting a lot of tariff on China and many other countries, including Canada and Mexico. Canada and Mexico around 25%, China around 35%. Initially, he was saying that he would be putting around tariff of 66% on China. What would be the ripple effect of this tariff war or this geopolitical tariff war? Only time will come. So there's a lot of volatility in the market. So overall, many economies are facing it, and hence the numbers are dipping. Okay. So persistently high inflation is reducing the disposable income, because when, for example, I've covered this earlier in daily decodes, inflation has increased, but urban spending is not increasing because wages and salaries of people are not increasing. So your inflation might have moved by 4%, 6%, 8%, but your salary is only moving by 1%, 2%. Appraisals are not happening. So if your salary is limited and things are becoming more costly, you will stop spending. Your focus would be to let's spend. So that is the problem, and that is why it is talking that RBI need to push more money, impetus of more money and capital in the market. That was the entire thing, that was industry is talking about, but RBI did not change the repo rate. It is still at 6.5%. Majorly they didn't have much of an option this time, and I would say that they were on a very tight rope, that balancing the economy, infusing money in the economy, at the same time balancing the inflation or controlling the inflation. So RBI emphasized prudent and cautious decision making, and most important statement has come that India is at a very critical juncture, and the American presidency and geopolitics which will come also will define a lot of things. Focus remains on achieving durable price stability and sustainable high growth. So price stability should be there and high growth should be there. This is easier said than done, and it's not easy. And Shaktikanta Das has been voted multiple times, the best central governor. So I think it's a tough time, tough spot, not only for India but many other countries, and I feel that RBI will come out stronger and better, and that too for our country also. So the question, MCQ repo rate has been reduced by, say, repo rate was not reduced. CRR was cut by 50 basis point to inject liquidity into the banking system. Inflation for 2024-2025 is projected at 4.8%, reflecting higher food prices. Second and third statement are right. Food prices is one of the major problems. Thank you for watching this video. For complete video, please watch Daily Decodes, and the link to that video is given in the description. And please don't forget to like, share and subscribe the channel, and do press the bell icon for all the updates.